Hey everyone, Mortgage Nerd here. So it seems like every day we're going to be working on these rates because right now I think we have to. So let's look at the charts here. We saw the big swings the last couple days, but today is probably the largest from 102.1 down to 99. So 200 basis points up and down in the same day. That's a lot. 100 was a lot. 200 is just crazy. Let's see what happened, because there was a point today that everything looked really good. So here's what I mean. We started the day off not bad, dropped, which is not good, all the way up here at 1 o'clock. Looks really good here at 1 o'clock. Why? Well, the Federal Reserve came out and injected billions of dollars into the treasuries. But why? Some are saying it's QE4, which is quantitative easing. I'm going to make a video on quantitative easing this week. But this wasn't quantitative easing, even though some thought it was or is. What happened is they thought it was, so then this happened. Boom, the mortgage bonds swung up, which means rates could have potentially gone down, but they never did. Nobody adjusted, the lenders never adjusted. What the Fed did is they injected liquidity into the market. Because if the banks don't have money to lend, if they're lending money, they're giving money to everyone, everyone's drawing their funds, the banks run out of money. So they needed liquidity. The Federal Reserve had to put money into the banks by buying treasuries. So all they did was inject liquidity. So what happened is when they got to this point, 30 minutes after, they said, wait a minute, this isn't quantitative easing. They're just injecting liquidity into the market, which is good. Long term, it's gonna be good, but it's not the quantitative easing that we were expecting. If the Fed comes in and starts buying mortgage bonds in large amounts, that's where we're probably gonna see this shift. And it might happen in the next couple of days, who knows? They're doing so much to try to keep this from getting to be a really, really bad recession. We're more than likely gonna see a recession here, maybe Q1 and Q2, GDP going down, that's a recession, 2 quarters in a row of negative GDP. Since then, the mortgage bonds dropped again tremendously, so we're not seeing any improvement in rates. It is what it is, not yet. It will happen. Wait till all this surplus, all these mortgages close. Those rates are gonna be high, refinances are gonna stop, all these mortgages in the pipeline are going to close. That's why the mortgage bonds continue to go down. I studied that last night when I was saying yesterday we don't know why, because we really didn't. We couldn't find the sign, but it's because of the surplus of mortgages, the mortgage bonds, the value of mortgage bonds are going down. So once these mortgages get out of the pipeline and everything goes back to kind of a normal pipeline, we're going to see those rates come down again, and then we're going to have another boom in the refinances. So don't feel like you're left out. Get your loans in process, get you in the pipeline, so when we get those low rates again, maybe they're not as low as they were 2 weeks ago, but if we get down there, we can lock you in. Phil Stevenson, Mortgage Nerd, thanks.